and a very good day to all of you. We are from class BA2724D UITM Bandaraya Melaka. On the 5th of May 2025, we had the incredible opportunity to meet one of the biggest names in the industry, Sir Ashraf Arshad. During this insightful session, we were introduced to the fundamentals of technical analysis, a vital skill in trading and investment. In this video, we are excited to share the valuable knowledge we gain, hoping it can benefit everyone just as it did for us. All the information is based on the explanations shared by Sir Ashraf, also widely known as AA Handsome. So, let's begin. Our journey into the world of finance began with understanding the four major types of income, each representing a different approach to building financial security and wealth. The first is known as active income. This is the kind of income you earn by working directly, such as through a job, freelancing, running a business, or even doing TikTok live. Next, we explore passive income. Unlike active income, this type continues to flow with little to no ongoing effort. Examples include rental income from property, dividends from investments, or royalties from intellectual property. We then learn about leverage income, which is generated through the work of others or systems you've created. This could be a business run by employees or an automated system. Finally, there is capital gains, which income earned from the increase in value of assets such as gold, stocks, crypto, or property. While it may not come regularly, capital gains can significantly boost your net worth when you sell assets at a profit. With that clear understanding of the types of income, we proceed into the content of the session, the Dow theory, which is a foundational concept in technical analysis. According to Dow theory, market price move in three types of trends. The primary trend is a long-term movement that can last for months or even years, and it can be either bullish or bearish. The secondary trend is a short-term correction that moves in the opposite direction of the primary trend, typically lasting weeks to a few months. Lastly, the minor trend represents very short-term price fluctuations, were usually lasting from days to weeks, and is considered market noise. Each of these trends pass through three phases. The first is the accumulation phase, where smart investors begin buying while the market is low and the sentiment is negative. This is followed by the public participation phase, when more investors start to recognize the trend and join in, pushing prices higher. Finally, the excess phase occurs when the market becomes overly optimistic and experienced investors start selling before a potential reversal. An important belief in Dow theory is that market action discounts everything. This means that all economic, political, and psychological factors are already reflected in stock prices. Therefore, price movements offer a real-time snapshot of the market's expectations and sentiment. Moreover, Dow emphasized that for a trend to be considered reliable, the market must confirm each other. This involves both the industrial average and the transportation average moving in the same direction. For instance, if the industrial average hits a new high, the transportation average should follow. If not, the trend may be weak or unreliable. Another key principle is that volume must confirm the trend. Volume acts as evidence of strength. High volume on up days indicates strong buying interest and supports a bullish trend, whereas high volume on down days reflects selling pressure, confirming a bearish trend. This helps traders avoid false signals by using volume as a supportive factor. Finally, we were reminded of a well-known trading phrase. The trend is your friend until it bends when it ends. This means traders should follow the current trend until there is clear evidence of a reversal. For example, in an uptrend, a failure to make new higher highs could signal weakening momentum. Being aware of these signs helps traders decide when to stay in a trend and when to exit.
Next, we also learned that a trend refers to the general direction in which the price of an asset is moving over time. This concept is fundamental in technical analysis as it guides traders in making informed buy or sell decisions. So right now, why trends matter for traders? Understanding trends allow traders to enable trend-following strategies, which are designed to ride the direction of the market. In addition, trading with the trend helps manage risk more effectively, as it aligning position with trend directions. Furthermore, recognizing trend provides critical context for identifying entry and exit points. Trends can be classified in two main ways, by duration and by directions. By durations, they are short-term trends which last from a few days to a few weeks, medium-term trends lasting from a few weeks to a few months, and long-term trends which span several months to years. By directions, trends are categorized into three types: uptrend, downtrend, and sideways. In an uptrend, prices make higher highs and higher lows. The strategy is to buy on dips and hold until trend shows signs of reversal. In a downtrend, prices make lower high and lower lows. Traders sell on rallies or short until trend breaks. In a sideways trend, prices move within a horizontal range with no clear directions. Traders buy near support, sell near resistance, or wait for a breakup. Furthermore, once we understood the fundamentals of trend, we learned about the method of a pullback, a necessity for technical traders. A pullback is a short-term price movement that goes against the current trend. It can be a brief dip during an uptrend or a small rally during a downtrend. Importantly, it is not a trend reversal, but rather a temporary correction or pause before the trend continues. What makes pullback so useful is that they are short-term movements in the opposite direction of the current trend. They are normal and healthy correction, not trend reversal. In fact, they are commonly seen as pause before the market continues its trend. Pullback provide opportunities for traders to enter a better price and with lower risk. A pullback gives traders a better entry point by buying lower in an uptrend or selling higher in a downtrend. This approach not only helps to reduce risk, but also improve trade timing and overall effectiveness in the market. Pullback matter in trading because they emphasize the importance of patience, allowing traders to approach the market with a calm and focused mindset. They help traders to avoid emotional and fear-based decisions, which are often the cause of poor entries and exits. Instead of rushing into trades impulsively, pullbacks encourage planned and disciplined entries, giving traders time to observe price behavior and act according to strategy. These shifts help traders transition from reaction-based behavior to strategy-based decision-making, which is essential for long-term consistency. Learning how to read and use pullback correctly can make a significant difference in a trading performance. In an uptrend, traders should wait for the price to pull back to a support level or to a moving average, such as the 20-day MA. Once the price reaches that zone, traders should look for bullish reversal candlestick patterns, such as a hammer or bullish engulfing candle, to confirm entry. Additionally, using indicators like RSI or stochastic to check for oversold level can further confirm the setup. In contrast, during a downtrend, traders wait for the price to pull back upward to a resistance level. Then, they look for bearish signals like the shooting star or bearish engulfing patterns before entering short position. These strategies allow traders to time entries more precisely and reduce unnecessary risk. The final topic covered by Sir Ashraf Arshad during our session was Fibonacci. What is Fibonacci? Based on a nature sequence 0, 1, 1, 2, 3, 5, 8 and so on, and golden ratio 0.618, Fibonacci is applied via Fibonacci retracement to identify support or resistance zone. Let's move to the three main common retracement levels. The 38.2% levels, also known as the minor level, is considered the buy the dip zone for traders in an uptrend. The 50% level, or midpoint, is not a true Fibonacci ratio, but is a popular level due to its psychological significance as a retracement level. The 61.8 level, also referred to as the golden zone, is considered highly influential in signaling potential price reversal. We would like to sincerely thank Sir Ashraf Arshad for generously sharing his knowledge, experience and insights with us during the sessions. It was not only educational but also very inspiring and motivating. Also, truly grateful for Sir Amaruddin, our FIN562 Technical Analysis lecturer, for his guidance and for giving us the opportunity to be part of this meaningful and beneficial learning experience. Thank you.